Hi there, Mike Brady with Generosity Wealth Management, a comprehensive, full-service wealth management firm headquartered right here in Boulder, Colorado. Today I want to talk about the 2014 review and the 2015 preview, spending most of the time, I think, on the preview. 2014 was a year that was not super high, super low, it was kind of right there in between. The large company unmanaged stock market indexes were in the low double digits, positive for this year. If it was a smaller company investment, it was in general the single digits on the low side, low single digits. Bonds, which I believe are essential for most portfolios, in 2014 they had the kind of the low to mid single digits. I'm going to use my hands here. I think that a good portfolio of stocks and bonds kind of meshed together with some cash. Those are sort of the core holdings. One thing that bonds did this year is they helped to reduce some of the volatility. If you're 100% stock market index, you're really kind of all over the place. And in 2014, there was a 7% decline in the S&P throughout the year. It did in the fourth quarter recover from that, which is wonderful. So that's positive for the year. I'm going to put up on the chart, up on the screen there, the S&P 500 going back to 1997. What you're going to see is there's some huge advances, some declines, advances, declines. Then I've just put a circle where we are right now. You can see there's that little tiny, I put a little arrow next to it, where we had that 7% decline in 2014. I'm going to put another chart up on the screen. Now you're going to see what it looks like going all the way back 114 years, back to 1900. You're going to see there's some times of great advance that can happen over decades. There's times of consolidation over decades as well. You're going to see there on the right-hand side where we are now. So the question we have to ask ourselves, are we at a consolidated period? Are we at a time of great advance? Of course, there could be a decline as well over many times. And so this is the environment that we have to make this decision in. I'm going to address it in just a few minutes before before I end the video. It is normal for there to be dips throughout the year. As a matter of fact, going back to 1900, it's normal for there to be about 3 dips of at least 5%. Historically, that's what's happened. It's normal for there to be a decline of at least 10% throughout the year when we look at the numbers going all the way back 114 years. Okay? Time is one of our best advantages. My advice that I give to someone who needs money in a year or two is completely different than the advice that I give when we're planning out 5 years, 10 years, 20, 30. If you're in your 60s or 70s, hopefully you're going to live a long life. You still have a long time horizon of hopefully of 10 or 20 years. And so the more that we can keep our eye on what the goal is, today is point A, point B is in the future. The more that we can keep track of what our goals are and in the future, the happier we will probably be. I'm going to put a chart up on the screen, and it shows kind of in numbers what I just talked about. This is 63 years, all the way back to 1950, of 100% stocks, 100% bonds, and then kind of a mishmash of the two. In each one of those groupings, it goes from on the left-hand side 1 year and on the right-hand side 20-year rolling time period. You're going to see that in each one of those groupings there's 3 bars, and the far right-hand bar is a match of stocks and bonds. The longer out we go, the longer our time horizon has been, kind of the range of returns, the highs have gotten lower and the lows have gotten higher, so that there's a more comfortable range, I would say. It kind of gets rid of the outliers on the top, kind of the outliers on the bottom. And so time is, without question, a great advantage that we have going forward. And so I constantly remind clients of where are we going to? What's our goal? What's our end game? And so how does 1 quarter, 1 year really fit into the bigger picture of a decade, 2 decades, etc.? Before we start talking about the preview, let me just tell you that I am optimistic going forward. I do believe that we're in the beginning of one of those nice big upward swings that could be multiple years, multiple decades. It doesn't mean it's going to be perfect and it's going to be an absolute straight line, but I am optimistic about that. I wanted to read something that Warren Buffett said, one of the best investors in history, and I really have a lot of respect for him. Is this quote right here that he said in the fall of 2008? Just to refresh your memory, 2008 was horrible, and it continued into January and February of 2009. And it was hard to find people who were optimistic at that point in time. What he said is this: "Let me be clear on one point. I can't predict the short-term movements of the stock market. I haven't the faintest idea as to whether stocks will be higher or lower a month or a year from now. What is likely, however, is that the markets will move higher, perhaps substantially so, well before either sentiment or the economy turns up. So if you wait for the robins, spring will be over." What's really interesting is after he said that, the market continued to go down another 20 or 30%, and he continued to make investments all the way down. And one of the best investments that he made was actually 5 months after the market completely bottomed out in March of 2009. But he was committed to his conviction that long-term investments in a portfolio, and he has a balanced portfolio, was in his best interest. And when I'm meeting with clients, we talk about how that might be in their best interest as well. I think that there are lagging and leading indicators. Lagging means that the end result. So let's say that you think that the market's going to go up. Well, we're not going to know whether or not that's true or not until we look back historically. So that's an indicator whether it was up or down after the fact, and then it's too late. I like to focus on some of the leading indicators. And 2 weeks ago, I did a video which I highly recommend that you look at. It came out around December 19th. So go to my webpage and look at that blog, or look at the archived newsletters. But at that time, I talked about some of the leading indicators about why I'm optimistic as things go forward, and adjusting my conversations with clients accordingly. One of them is the S&P 500 PE ratio. Right now it's around 16%. As it creeps up towards 20, that's going to be a major leading indicator for me, as my optimism might go towards more pessimism. Okay, I'm also going to look at earnings per share. Whether or not that's been a drop. The 10-year yield on the Treasury, right now it's at 2.18. As it gets closer to 3.5, 4, and 5, I think that's going to be something that will start to give us leading indications of some problems in the future. Declining investment percentage as a percentage of the GDP. And finally, China. You'll notice that I talk about China primarily as it relates to their economy and the impact on the world. But if you're looking, there's always a number of reasons not to invest, not to be optimistic. You can always find every year, and 2015 is going to be no different, a reason to say, well, it's different this time. Well, what about North Korea? What about the Middle East? What about this? What about that? There's always, and I can sit here and point to you every year, some events that drive the market for a relatively short time, but long term, the fundamentals of the market win out. And in my opinion, the fundamentals are positive at this point. And I'm a believer, like Warren Buffett, that the market in general will be higher in the future than it is today. And so we have to create a portfolio that's individualized to us for to make sure that our behavior allows us to stay invested in that. Just a couple other things before I say goodbye here today is I do believe that consumer spending growth will be good going forward, particularly with lower oil prices. I think that's going to be a very positive thing. And is core inflation going to be affected this next year or two? The 2% target from the Fed, I don't think we're even going to get close to that. So I think that interest rates are going to continue to stay low through 2015 and maybe even to 2016. And this is ultimately, I think, a good thing for us. So these are some of my arguments about why I'm optimistic. But in general, I'm a very optimistic person about the long term for this. And I think that it's my client's best interest as well. But please don't make any decisions without talking with your advisor or without talking with me. It's real important to keep the long-term vision in your mind, but you also have to define what those goals are. And you got to find something that allows you, from a behavior point of view, to stay true to what your core is. That's my preview and my discussion today. Always, I love to hear from you. Mike Brady, Generosity Wealth Management, 303-747-6455. You have a wonderful day. Give me a call at any time. Bye-bye.